Alex graduated with $38,000 in federal loans and has been making income-based payments faithfully for 3 years without missing any. Maya graduated with the same $38,000 in federal student loans and is about to receive a letter changing her monthly payment permanently. The federal student loan system is undergoing its biggest structural change in decades, and 45 million borrowers have no idea what is coming. New 2026 legislation is eliminating income-driven repayment plans that millions of borrowers have relied on for years to keep payments low. Let's run the real math on what these changes mean for Alex and Maya and what every student loan borrower needs to calculate right now. Alex earns $52,000 per year and has been paying $187 per month under the Save Income-Driven Repayment Plan he enrolled in after graduation. His $187 monthly payment felt manageable, and he assumed it would stay roughly the same as long as his income stayed in the same range. Under the new rules, Alex's payment is recalculated using standard repayment. His new monthly payment will be $412 per month instead. Alex's monthly student loan payment is going from $187 to $412, an increase of $225 per month appearing on his next billing statement. Maya earns $48,000 per year and has been paying $143 per month under Save, planning her entire monthly budget around that amount carefully. Maya's new standard repayment payment will be $378 per month, an increase of $235 per month that she has not budgeted for at all right now. Neither Alex nor Maya made financial mistakes. They enrolled in the plan their loan servicer recommended and paid every month consistently. The SAVE plan was introduced by the Department of Education in 2023 as the most affordable, income-driven repayment option ever available. Federal courts struck down key SAVE provisions in 2025, and Congress eliminated the remaining provisions in the 2026 budget legislation. Borrowers who built their lives around SAVE payments now face payment increases averaging $180 to $350 per month across the country today. Let's look at what a $225 monthly increase means for Alex's financial position over the next 5 years if he cannot absorb the new amount. Alex currently saves $380 per month. After all expenses, his rate is modest but consistent as he builds his emergency fund each month now. The $225 increase immediately drops his monthly savings from $380 to $155. A 59% reduction in his ability to save from one policy change. If Alex redirects his savings to absorb the increase, he takes 14 months longer to reach his 6-month emergency fund target than planned. If Alex was investing $200 per month before the change, that investment drops to zero and his wealth building stops until his income rises. Over 5 years, stopping $200 monthly investments cost Alex approximately $15,000 in foregone portfolio growth at 10% annual return today. Now let's look at what happens if Alex cannot make the new $412 payment and begins missing payments or going into deferment as a result. A single missed payment after a 90-day delinquency triggers a credit score drop of approximately 60 to 110 points happening immediately. That score drop affects every future decision: mortgage rates, car loan rates, insurance premiums, and apartment rental applications. On a $280,000 mortgage, the difference between a 720 and 650 credit score is approximately $47,000 in total interest paid over 30 years. Let's look at the 3 repayment options Alex and Maya actually have available to them under the new rules starting immediately right now. Option 1 is the standard 10-year repayment plan, fixed payments of $412 for Alex and $378 for Maya until the loan is completely paid off. Option 1 produces the highest monthly payment but lowest total interest. Alex pays approximately $11,400 in total interest over 10 years. Option 2 is graduated repayment, lower payments now increasing every 2 years for borrowers expecting their income to grow over time. Under graduated repayment, Alex starts at $240 per month, rising to $720 by the end. Total interest paid is approximately $16, $800 over term. Option 3 is refinancing to a private lender, lower rates, but permanent loss of all federal protections and loan forgiveness rights. Private refinancing could drop Alex's payment to $340, but eliminates income-driven options permanently if his financial situation changes. The forgiveness trade-off in private refinancing is significant. Federal loans qualify for public service loan forgiveness after 10 years. If Alex works in public service, his remaining federal loan balance could be forgiven completely tax-free after 120 qualifying payments made. Refinancing to private eliminates forgiveness permanently, a choice that costs tens of thousands of dollars if his situation ever changes. Here's the calculation every borrower should run before deciding between standard repayment, graduated repayment, and private refinancing. Step 1. Calculate your total loan balance, interest rate, and remaining term under each repayment option you currently qualify to use. Step 2. Calculate total interest paid over the full loan term under each option, not just the monthly payment shown on your statement. Step 3. Calculate the opportunity cost of each payment by comparing what the difference invested would produce over 10 years at 10%. Step 4. If you qualify for PSLF, calculate the total cost, including forgiven balance, before choosing any private refinancing option ever. Alex discovers standard repayment costs less total interest than graduated repayment by approximately $5,400 over the complete loan term. Alex also discovers if he qualifies for PSLF, his remaining balance after 10 years would be approximately $22,000 forgiven completely free. The PSLF calculation changes everything if Alex qualifies. Standard federal repayment at $412 beats private refinancing by a wide margin. Maya does not work in public service, so PSLF does not apply. Her decision between standard and private refinancing is more straightforward. For Maya, standard repayment at $378 versus private refinancing at $310 is a $68 monthly gap that requires the full 4-step calculation. Over 10 years, Maya saves $8,160 by refinancing, but gives up federal income-driven options if her income drops or she loses her job entirely. If Maya loses her job with federal loans, she could request income-driven forbearance with private loans. That option disappears completely. The insurance value of federal protections is significant, and most borrowers undervalue it completely when comparing monthly payment rates. Now let's be fair about who should seriously consider private refinancing despite the federal protection trade-off it permanently creates. Private refinancing makes sense if you work in the private sector with stable income and your rate would drop by at least 1 full percent. Private refinancing makes sense if your balance is low enough that forgiveness programs would not produce meaningful savings over your term. Private refinancing makes sense if you have a strong emergency fund, stable employment, and the monthly savings would go into investments. Private refinancing does not make sense if you have any PSLF path, work in education or government, or face realistic income uncertainty. Alex and Maya are not statistics. They followed the rules, made responsible choices, and are now facing an unwelcome payment surprise. The surprise is not their fault. It is the result of a policy change that altered terms millions of people had built their plans around. What they do next determines whether this increase becomes a temporary disruption or a permanent setback to their long-term financial paths. The borrowers who navigate this successfully will be the ones who run the full 4-step calculation before making any repayment decision. The borrowers who struggle will accept whatever payment their servicer presents without understanding all their available repayment options. So, if you have federal student loans, the most important task right now is not paying this month's bill. It is running the complete math. What is your total interest cost under every option, and does any federal forgiveness program actually change that total cost calculation? Because those two numbers, not your monthly payment, are the only complete picture of what your student loans will actually cost you.